Hello, everyone, and welcome to the Your Mark on the World show. I'm your host, Devin Thorpe, and our guest today is John Goldstein of Imprint Capital. He is the founder and managing director. John, thank you very much for joining us this morning. It's great to have you.
Hey, Devin, thanks so much for having me. Looking forward to it.
John, you are a rare breed among impact investors in that you've done this enough that you're no longer an amateur. You've been doing this for a while now. You've put some real money into impact investments, and so we're really grateful that you would take some time to share some of the insights and lessons learned. But tell us a little bit about some of the impact investments you've made. Give us just a little foundation to understand your perspective.
Well, and I think broadly speaking, we've made impact investments on behalf of large foundations. So we've worked with 10 of the 25 largest foundations who tend to have very specific mission interests, highly tailored to their philanthropic purpose. To high net worth individuals, family offices, and financial institutions who may have broader mission interests as they flesh out a conventional investment portfolio. And I think our investments really reflect that span. And both one of the wonderful things about impact investing, but one of the challenges is the diversity of what that sort of big tent term contains. Because we often find ourselves with that pivot to using the term impact investing has been tremendously useful at opening eyes, building awareness, building excitement, but now it's to the point where there's enough under that tent that parsing it becomes a good next step. So when we think about our own investments, I'd say 75% of our investments are in the private markets. Now, we don't say public market investing doesn't count. I think we're very anti-drawing a bright line. We think people spend a lot of time debating where to draw a magical bright line around what counts and what doesn't, as opposed to recognizing different investments have different financial characteristics and different impact characteristics, and let's do the best we can. And a lot of time spent debating who owns a term could maybe be better employed making these investments. But in terms of our scope, it really ranges from creatively creating public markets instruments where they haven't existed, so working with folks like Aperio to help them create a green index product for folks that wanted sustainability exposure, working with the McKnight Foundation and Mercer Investments with Mellon Capital Management for the McKnight Foundation to have a clean version of the Russell 3000 index fund, so some public markets work to kind of bread and butter private fund manager selection. Could be absolute return managers, real estate managers, private equity managers that have a strong impact thesis and a strong financial thesis, all the way down to direct investments in social enterprises, from Revolution Foods to a Root Capital, who are having a much more direct impact on the ground, but it's not quite as simple as seamlessly slot a fund into a conventional asset allocation. So across those 100+ investments, we've invested in literally every asset class and about every mission area you can imagine.
But it really is an interesting perspective that you bring to us now. So it sounds to me like essentially all of the investments that you're making under this umbrella of impact investing are available only to high net worth and institutional investors. Is that perception correct?
That's really the overwhelming bulk. And I think there's really important work that's been going on to try to democratize access. And I think the Calvert Foundation, who we've invested in and who we admire a lot, has done really groundbreaking work in letting people in their own community participate in very small check sizes in investments in their community. Folks like Solar Mosaic are working on that, some of the crowdfunding efforts. But most of the investments we focus on tend to be available only to larger investors have large investment minimums. But I think it's important that field of making things accessible is changing really rapidly. I think the top performing fixed income manager in his class last year that's accessible in mutual fund form to most folks was the TIAA Pref Social Choice Bond Fund. And so I think the world is working to sort of help match that growing demand across a wide swath of investors for this. And this particularly is where it's an interesting coalition between dedicated impact players like Calvert Foundation and then some of the larger institutions, the Morgan Stanleys of the world, working to build out their platforms.
So give us some of the insights from all the investments you've done. How do you screen for impact? How do you screen for investment criteria on a traditional metric and without ignoring the impact?
Yeah, and I think for us, number one, it's clarity of what are we trying to achieve. because and kind of setting the objectives and the search parameters up front as opposed to adjusting the goalposts with the benefit of hindsight. So are we looking for something where the expectation is a market rate of return? Or are we looking for something to achieve a specific social purpose? We may have more financial flexibility. And so what we tend to do is when we're building our databases and our view of the marketplace, we're tending to approach from either an asset class perspective, where you're really looking to contextualize a top pick within a peer universe in a way that the process looks not entirely dissimilar from what conventional investment firms do, but there has to be a clear impact thesis within the fund manager, to where we're doing dedicated sector scanning. And this is where the work we do with the large foundations is really important, where instead of saying we're looking at private equity, we say we're looking at climate and energy, from natural resources to energy generation to transit and storage to energy efficiency, and we're thinking of those. And I think it's really putting those two things together that you have access to the smorgasbord, because a lot of people wrestle. Are you finance first or impact first? Is this market rate of return? Is this not? And I think a thing I say a lot, and I often try to start meetings with this, is you're going to hear me say it depends an awful lot. Because generally speaking, generalizations don't work very well in this space, because investments are diverse and have wide varieties of characteristics. Why would impact investments be any different? And so for us, it's be clear around where is this fitting in our universe. Is this trying to be a top pick within an asset class to go into folks with broader mission interests, from vulnerable populations to climate and energy? Or is this trying to accomplish very specific social purpose for a much more specific mandate we have? And those processes, those screens and filters look really different, but it really all starts with any investment. What is the financial thesis? Why will this be successful at generating whatever returns it's trying to generate? And an impact thesis. Why do we think this does something good in the world? What are the key assumptions that leans on? And finally, how do those two things fit together? Because people often talk about trade-offs. And I think one of the things that we see is the investments we tend to like the best are where the financial thesis and the impact thesis are really tightly aligned. We'd finished a meeting with a family office, and we're grabbing a beer at a bar afterwards before heading to the airport. And it was kind of loud because it was Portland, people were getting ready to go to a Timbers game. And you had a bunch of feisty soccer fans. But I thought I heard the person next to me mention the name of a sustainable timber manager we're invested in. So I turned to them. I said, "Do you mention this manager?" And they said, "Yeah." I said, "Oh, you're an impact investor." And they said, "What?" I said, "Well, explain." And it turns out they're the real asset investment team for a European national pension fund that owns and operates lots of forests in their home country. And we're looking to diversify. They wanted U.S. timber exposure. They started with a long list of 45 managers, screened it down to 15, and allocated to 5. And of those 5, 2 of the 5 are sustainable managers. And when he described why they invested, they have a differentiated thesis that works well in this market. And it sounded very kind of conventional investments. But in our world, that's saying the impact thesis is actually quite aligned with how you succeed in a competitive investment fund. That's not the case everywhere, right? It's not the case with every manager and strategy. But I think it's one of the things we particularly listen to as we look at investments.
But it does make perfect sense to look for those opportunities where the mission and the money are perfectly aligned, so that more money only happens when more mission is accomplished, right?
Yeah, and I think another question people ask is about mission drift, which is how do you know that this company is going to stay on track? And I think a lot of folks want to build conditions and covenants in with the investor or have governance rights. And I think we often see, unless the business model is tied to what we want to have happen, once again, that financial impact thesis, you're kind of pushing against a tide. And a good example, actually, is our friends at Revolution Foods. Great social enterprise, has had financial success, has had mission success, just in terms of as they've grown as a business. Great entrepreneurs. But one of the questions when we first looked at investing is, are they just going to go up market? They produce healthy school lunches for low-income kids, but are they just going to go and try to produce school lunches at wealthy schools? And when you break down the economic model, it actually works better serving low-income schools because the participation rate in the school lunch program is high and stable. And what that means is that because it's high, you have bigger drop sizes, which is good for your margins for operating within a region. And stable means there's less waste, which is good for your gross margin. And so be able to really think about how does the mission and the financial sort of really of a business or of a fund, how do those really tie together? And are those going to be moving you in this right direction, or are they kind of be butting heads over time?
Yeah, great insights. Listen, I want to have a couple of follow-up questions here, or tangents perhaps. as you think about impact investing, who do you admire? Who do you think about as a role model? Maybe not even for impact investing, but for your life. You've chosen to do something outside of the mainstream, impact focused. Who's your role model? Who do you admire?
You know, it's right. Just back to the secret of how movie magic gets made. You gave me a heads up I'd get this question, and I've been thinking about it. It's really hard to pick because there are so many, and I think broadly, there are three types of folks, and I actually will give you an answer to the question. I think broadly, the folks that really built this field. This has gotten a lot of glamour and limelight in the last 5-7 years, and we've been really lucky to be a part of it. But that all builds off of decades and decades of work from faith-based investors working in getting microfinance launched in investments, the U.S. CDFI sector, the SRI sector working in shareholder advocacy, a whole host of folks working for a really, really long time. And so I have admiration because that had real impact. That sort of built us to getting to kind of the next S curve. Then there's a whole set of folks that have been part of this next S curve, right? The Anthony Buglevies of the world, the Andrew Kasoys, the Brian Trusted, you name it. It's a long list of people, and just have kind of helped as that gets to this next wave of iteration. The third are those folks that take the leadership, and it could be individuals with their own wealth. It could be trustees of a foundation that say, let's not overcomplicate this. Let's realize if we can do this well, it is a constructive thing to do. So let's try to do it well. They cut the Gordian knot of debating the weather and get into the how do we do this well. But so in terms of a specific person, I have to say a longtime friend and colleague who's been doing this way, way longer than I have, Jed Emerson, is someone I particularly admire, and I think there are a couple of reasons. Number one, his career and his work spans from being an on-the-ground practitioner working with homeless street kids up to writing academic papers at Stanford. And to be able to have that scope of work, to be able to play at that high intellectual level and really building some of the intellectual building blocks for what we all do, but actually also do the hands-on work is something I have a huge, huge respect for. Number two is the period of time. He's been plugging away at sort of a fundamental project for a long, long, long time. Number three is the impact. We all owe so much to that work and him rattling a lot of cages. And I think four is the fact that he approaches this with a very different style than I do and we do, which is he's been an amazing thinker, advocate, now transitioning to working with a set of families as a doer, where it's almost the bump set spike. You need the advocates and the thought leaders to build momentum, and then folks that are the sober, quiet, okay, now we can help implement. I think that in his early career, now he's gotten to say, wait a second, now I get to go do this. But the sweep of his career and the sweep of his impact is something I have a ton of admiration for, and I think we all owe a real debt to him.
Oh, that's great. I appreciate you sharing that information, that insight. Now, why do you care about impact investing? How did you get into this, and why does it matter to you?
It's interesting in the sense that my best reflection on it actually came from somebody else. So I was meeting with a guy named Buzz Schmidt, and we were talking about life and what I was doing. This is actually as I was transitioning to really start Imprint, and he sort of looked at me and said, "For you, it's not the pictures of the vulnerable communities. It's not the stories and the anecdotes. You see a fundamental problem that needs to get solved and that matters, and that in and of itself is a motivating force for you." And I think as he said it, I realized that was true. I started life as a strategy consultant. And as a strategy consultant, you see industries and business models that aren't working as efficiently and effectively as they should, and you try to fix them. And that's intellectually interesting work. At the risk of heresy, I might venture to say I don't know that it's the world's most important work. And then as I started to get a sense that the systems that are trying to tackle problems that really matter, climate change, vulnerable populations, that those have the same challenges, the same dysfunctions, the same barriers. Smart people with a lot of resources have worked for a really long time trying to solve hard problems, and it's really hard. Like when you see that, suddenly that's a problem worth solving. At number one. Number two, from my past life in the information business, this idea that one of the ways to add value is sort of almost an efficient market thesis in impact, which is you need to recognize really smart people who have been working on all this stuff for a long time. So if any of us come along and say, I've got a bright idea, it's kind of like if you think you can beat the stock market, right? Lots of smart people are looking at it too. And so what I recognized is one of the things that can add value is bridging different perspectives. People who speak different languages and aren't very good at speaking to each other. And we ran an information business that kind of translated between the policy world and the market world. And here, this idea of you have advocates who want all the right things but can't necessarily have that conversation with a conservative, financially oriented trustee. Or you have conversations where people get stuck because they're really talking past each other. You know, I think we had a family foundation that was stuck for 3 years debating whether to do impact investing because one investment committee member who was a very successful commercial investor thought they should eventually get to 2 to 4%. A family member thought they should get to 100%. And somewhere between 2 and 100, or as I say, somewhere between the moon and New York City, they were stuck.
Yeah.
And to be able to kind of listen to that and say, you know, what you're actually doing is you're not debating what you should do. You're actually debating hypotheses around where you think things will end up. But you have an investment committee, you have a process, you have a set of standards. So why don't you agree you can use those same people, those same standards, and look at some different managers. If they pass muster, you invest in them. If they don't, you won't. If you invest in them and they perform, you'll keep them. And if they don't, you will fire them. And everyone could agree to that. You know, they all had very different expectations of what would happen. But that family foundation, 2 years in, has crossed the 50% invested in impact mark. Things are going well. Everybody thinks they got their way. Because the conservative voice said, see, I insisted we use good process, we rigor, we do this right, and that's why it's working well. And the person that wanted to do this said, oh my gosh, look at the progress we've made. I think just to be able to realize that the value is not of coming up with a new idea. Other people have come up with all these ideas, but to be able to listen in a way to bridge those differences, I think that's the thing that I found has been a distinctive, you know, value add. I think the other thing is a willingness, and this is something, you know, that Taylor Jordan, who founded the firm with me, and I, just to say, let's, instead of trying to figure out how we bolt impact onto an existing business model, how do you actually build something for this exercise, which is more research intensive, more structurally complex, more organizationally complex, and by the way, you know, people won't necessarily pay a premium for it. So how do you tailor an enterprise around doing that? And that excitement of saying, how do you try to have a purpose-built entity to problem solve for some of the fundamental issues here? Because I think one of the things that people have glossed over very often, and we try not to, is this is hard. It's not all great. Now, that also happens to be the case with conventional investments. We show a chart a lot because of risk-return dispersion of public equity managers, sort of ESG impact managers and non-ESG impact managers. And when I'm feeling provocative and standing in front of an audience, I'll say, you know, what does this chart tell you? And I'll say, what it tells me is most active ESG and impact managers are mediocre to lousy. And so are most non-impact managers. Picking good investment managers is hard work, and most people don't do it that well, but you know, I think to kind of get past the generalizations and realize how do we honestly engage with the fact that, as with any investing or any effort to have an impact, it is messy, it is hard, it's highly dependent on how well you execute, which I think some people take as bad news, kind of a buzzkill, but for me, that's the good news, which is if this is actually susceptible to good work, focus, and execution, that gives us all a shot. And I think what we can all do is roll up our sleeves and try to do it. And I think to your point, we're getting out of the novice phase, and we have a decent amount of experience, but we're learning something new every day. How do these different assets perform? How do we think about impact? How do we allocate capital for impact? How do we think when we have the flexibility to make a market-oriented investment or not? How do we think about how to thoughtfully use that? And I think this realization, it's not a binary, I do it, I don't, it's good, it's bad. It's how do you start a process of continuous learning and improvement and iteration around it?
Sure. Well, it's been just wonderful to have an opportunity to visit with you, John. I really appreciate you sharing your insights with us today. Before we go, tell us how people can get in touch with you if they'd like to hire you or if they'd like to engage with you in some other way.
Yeah, and to be clear, we're very happy to share what we've learned in the sense that we've been really fortunate to have folks let us have a chance to get out there and learn by doing, and as a result, we feel a real both obligation to, but also excitement in sharing what we've learned. So we're always happy to do that. So folks can find me on Twitter at @ImpactInvestor, an appropriately labeled handle, or you can just email me at jgoldstein@imprintcap.com.
Very good. Well, John, again, we thank you very much for your time today. It's just been a joy to talk to you, and we wish you every success in your work.
Hey, Devin, thanks so much for having me, and thanks so much for hosting this. And everybody, thanks for tuning in.
All righty. Let's do some good.
Cheers.